Ladies and gentlemen, good morning from Schiphol Airport in Amsterdam. Welcome to the second TCI week organized by ICISA. My name is Richard Wolf. I head up the ICISA Secretariat. And this TCI week, we're happy to organize following on from the success of the first one last year. The primary reason for organizing TCI week is to increase the awareness and to showcase the trade credit insurance industry. My personal goal, and it's an ambitious one, is when I go to a birthday party and I say I do trade credit insurance, to never again have to explain what that is. So we hope we can contribute to this in a small way. This week, we'll have a range of topics. We'll have a number of strategic topics, such as the keynote address you're about to hear, and the path to growth of this afternoon. We've got some geographical areas that we'd like to put in the spotlight, such as Sub-Saharan Africa and trade credit insurance in Asia. And we've got some more focused, specific topics, such as the use of artificial intelligence, embracing sustainability, and the re-emergence, if that's the right word, of political risk. Now, I hope you've seen this, and I hope you agree that the lineup of speakers is quite impressive this year. You're most welcome to still register for events where you haven't registered yet. This will also enable you to watch the recordings of these TCI week items at a later time, in case you were not in the position to view it live. We will make these available through our website, icisa.org. Now, let us turn to the keynote speech that is about to commence. Mr. Antonio Fernandez Martos will deliver his speech from the point of view of the Commission of the European Union. Antonio has been involved with trade in his working life since 1997, working for the Commission and working for the Spanish government in different roles. He is currently in charge of multilateral affairs at the Director General for Trade of the European Commission. His previous roles include responsibility for international investment policy and conducting the negotiations between the EU and the UK on the Trade and Cooperation Agreement. Antonio will speak on the importance of multilateral engagements and the EU strategy on export credit. Now, these topics are obviously of importance for those of us conducting business in the European Union, but will have far-reaching consequences outside this area. You're most welcome to put questions to Antonio via the button that you see on the bottom right-hand side of your screen. I can't promise that we'll get to each and every question, but I'm sure that Antonio will do his best to answer them. With that, it is my honor and pleasure to invite Antonio to deliver his remarks. Antonio, the floor is yours.
Can you hear me? Can you hear me? Can you hear me? Can you hear me? So you can hear me. That's okay? Sorry. Sorry. Yeah, okay, sorry for that. Okay, my apologies. Now, can you hear me now? No. The line got cut again, but I can't hear you. Okay, I'll speak, but I can't hear you. Okay. All right, sorry for this. I'm glad that you can hear me. It feels a bit strange to speak, but not being very sure of whether you get what I'm saying. So I'll start by referring to the trade policy of the Union. As you know, we are living through a difficult period, and that means that trade policy is in a process of transformation. This is due to the geopolitical tensions that we are going through, and that includes notably US-China strategic competition, but also the war in Ukraine that has generated, let's say, a big impact globally. It has put a lot of strain on supply chains internationally, and notably those around the Union, but also across the world, notably when it comes to food. All in all, we can say that this amounts to a crisis of multilateralism, and this in a context where we have massive economic challenges to deal with as well, not least because of the pandemic that we are still recovering from economically, inflation, energy prices in Europe, the supply chain disruptions that I mentioned earlier. And then, as far as the Union is concerned, there's a risk of a loss of competitiveness in a context where, because of these geopolitical tensions, the overall paradigm is changing from one based on efficiency to one based on resilience. So we have to make sure that we stay resilient. I think that the COVID pandemic was a wake-up call in that regard, but I think the situation of geopolitical tension made us aware of the need to increase our resilience. And of course, we have climate change as a big challenge that we are trying to deal with, and that has an impact on our trade policy as well. So we have that overall complex situation, a situation of increased uncertainty, and of a real risk of fragmentation of the global economy, moving potentially from a rules-based order that we know well to a global order that is more based on power and power dynamics, and including also weaponization of trade, as we are seeing notably as a result of the war in Ukraine, but also in the context of the geopolitical tensions that I mentioned earlier between the US and China. So this is something that has brought the Union to basically update its trade policy and its trade policy tools, and that the Union had seen already a few years ago. If you have a look at the Trade Policy Review communication from 2021, you will see that the title speaks about economic transformation, a time of economic transformation, and a time of geopolitical instability. And this is the way we characterized the world of 2030. That's where we're moving towards, and I think what has happened in the last couple of years has confirmed what we had anticipated in 2021. That means that we need a strong trade policy, trade policy that continues to strengthen the EU's competitiveness. We need to continue to build and consolidate our single market, because that is the basis of our competitiveness and our strength, and also of our political strength, and the main foundation of the EU as a trading power, which is particularly important in this world that we are now getting into. And in this context of competitiveness, export credit plays an important role, a role that has been growing as well, and that we had identified as well as a necessity in 2021 in the same trade policy review communication. The angle that the trade policy review communication from 2021 took in relation to export credits was based on the context of level playing field. So this wasn't a level playing field concern, was what led us to put into the communication the idea that we should explore options for a union strategy for export credits. So we thought that EU businesses in third country markets had to increasingly compete with financial support from the governments that we could not match, not least because this support was being provided in unfair terms, and this required to look, of course, at many other tools that are there to deal with unfair trade, but also led us to propose the idea of a new strategy for export credits. And since then, we have been embarked in that, and I will get into that in a minute. But before that, I want to also refer to the Global Gateway. So in February 2021, we went into this export credit strategy, and then the strategy surfaced already in the Global Gateway communication that came at the end of that same year. At the end of 2021, we had the Global Gateway communication, which, as you know, is intends to be the EU contribution to the global investment gap. So there's an investment gap across the world, and we want to contribute to filling that gap, and notably to help global economic recovery, but also support the twin green and digital transition. So that was the idea with the Global Gateway communication. It had a focus on a number of priority areas. One key objective was enhance connectivity and definitely support a trade-friendly environment in our partner countries. One particular feature of Global Gateway, which is relevant for export credit, is that it put the concept of Team Europe approach at the forefront. Team Europe approach is basically about a whole of government approach. A whole of government approach, which is of course more complex to implement at the level of the European Union, because it implies combining the strengths and the tools of the union institutions with those of the member states. But this is how Global Gateway is supposed to be delivered, through a Team Europe approach, meaning a whole of government approach. And this is very relevant as an objective, and will hopefully help us deliver on the Global Gateway objective of delivering or mobilizing rather 300 billion euro by 2027. So that's the headline ambition. So Global Gateway was there, and it is important to note, because I mentioned that the strategy surfaced in the Global Gateway communication at the end of 21. It referred specifically to a potential export credit facility as a tool relevant for the implementation of Global Gateway. So that was there already, and on that basis, Global Gateway, this launch of the idea of a strategy in the trade policy review communication, we moved on to generate the building blocks for that strategy, which is what we have been working on for the last couple of years. If you have a look at the trade policy review, you will see already those building blocks. It mentions the possibility of an EU export credit facility. It mentions the idea of an enhanced coordination of the EU external financial tools, and it mentions also the idea of incentivizing climate-friendly technology projects. So the climate objective is also very present in that initial moment of the export credit strategy. So we have acted in a way externally, notably in the OECD, and through the modernization of the OECD framework, which, as you know, is the framework of rules that regulates how export credit operates internationally. And then we have acted domestically, where we have been dealing with essentially a feasibility study, and that will be my second area that I will cover. Let me briefly refer to the modernization of the OECD arrangement, because this is important. As I have said at the beginning, the strategy is launched in a context of level playing field concern. So we have an issue that the Union is perceived as falling behind in global competition, also because the financial support that it is offering through the tools, notably in the hands of member states to its operators, are not up to the challenge. One problem was that the international regulatory framework, the OECD arrangement on officially supported export credit, had become a straitjacket. It had been agreed in response to basically the risk of subsidy races, but it had become a straitjacket, and it was no longer in line with market needs or the needs of operators. And the Union proposed to modernize the OECD arrangement in the direction of making the terms and conditions, the financial terms and conditions that export credit agencies apply, more flexible. The Union was vindicated when, in June last year, we were able to conclude a very ambitious modernization, the most significant since the 90s, and it is a real milestone, we think, for European exporters, because Union export credit agencies are the main providers of export credits. If you look at the 11 participants in the OECD arrangement, and what we have achieved is essentially more flexible terms and conditions to be able to better meet the needs of EU business in international competition. For example, through extending the maximum repayment terms, which is increased from, I mean, of course, depending on the project, but from between 8.5, 8.5, and 10 years up to 15 years. And then for climate-friendly transactions from 18 years, because there's a specific sector understanding on climate-friendly transactions. There, the maximum repayment term goes from 18 to up to 22 years. The minimum premium rates that export credit agencies are obliged to charge for their cover will be reduced for longer repayment periods. And then there are also flexibilities in relation to the repayment profile. So a very significant change from that perspective, coupled with additional incentives for green and climate-friendly projects. So we have expanded the terms of the climate change sector understanding, and done this on the basis of the let's say approach in the EU taxonomy. So we have now a much longer list and much more adapted to today's world of climate-friendly technologies that can benefit from additional incentives, and therefore from more flexible terms and conditions. So this is what has been achieved, and we have now new rules that are in place, and that put us in a better position. And that puts our export credit agencies in a better position to support the international business of operators. So that's important. And then I want to move. So that's let's say the main achievement in the external dimension. One other achievement is that we have also worked in the direction of reducing support for fossil fuel projects, and we succeeded at the end of 2021 in the OECD as well to basically ban financial support for unabated coal-fired power plants. And we have there a review clause to move further in that direction, in the direction of banning support fossil fuel projects. So that's already one success in relation to coal, and more work to be done in relation to other fossil fuels. So that's the external dimension. There is the domestic dimension, and on that front, what we did was to ask a team of consultants to prepare a feasibility study on a union strategy on export credits that would consider among others the possibility of a union facility on export credit, and this feasibility study included let's say considered as well the idea of enhanced coordination. So this whole of government approach that I had referred to. I will start perhaps with the outcome of the feasibility study. So the feasibility study essentially, well, confirmed there's an issue of competitiveness for the union, especially when it comes to high value capital goods and emerging markets. We have seen that progressively the overall share of the union in world exports has been going down 3% over the last decade. But for capital goods, this reduction is of 9% in developing country market. This is, of course, due to various reasons. One is that China is offering cheaper capital goods that are perhaps tailored to the needs of these emerging countries, but also coming with financing packages that we are not able to match. So what we have is recommendations in the feasibility study, and those recommendations, of course, start by taking stock of the reality of the union export credit system. It's not a position of weakness. We are facing competitiveness issues in world markets, but we are not starting from a position of weakness. But the union system is nonetheless fragmented, because it is in fact many different systems that sometimes overlap with different products offered in different member states, and that generates challenges. I mean, the first conclusion is that because of this patchwork, let's say, of export credit support systems, any response to the competitiveness challenge that the EU is facing must come through many strands of work that will involve multiple actors. So I think that's a clear conclusion from the study. The study also identifies, let's say, multi-sourcing as a problem. Also because I mean, export credit agencies have their different procedures. They have to comply with national content requirements, and this makes it more difficult for them to cover EU content in projects. There is some EU level, let's say, or coordination between the export credit agencies of member states, but this cooperation is not systematic. It is not sufficiently well organized. So there's that issue that has to be dealt with. One other conclusion of the study is that there is a lack of access to finance in certain situations where perhaps EU involvement would be desirable. And an example of that would be strategic partners or strategic projects. For example, climate would be one such objective. For example, Ukraine. For example, access to critical raw materials. So there are certain situations where there is a case to be made for EU level involvement. The report also noted that the volume of tied aid is very limited in the EU, and that the coordination between trade finance and development finance is very poor. So these are separate universes. There's not enough coordination, and this is a problem because we see other countries following a very efficient whole of government approach where they combine the development finance and export finance resources, and that puts them in a much better position. So the study on that basis recommended a number of actions, including a better coordination between trade finance and development finance. It recommended as well the creation of some form of EU-level export finance support, either focused on strategic projects or more generally. This in various forms, so it could be in the form of pure cover, it could be through refinancing, through the creation of a tied aid facility. So it gave a number of ideas of what could be done. And then it insisted as well on the importance of enhanced coordination. Enhanced coordination is something that had been explicitly mentioned in the trade policy review communication. That's something that we should be moving forward. And the feasibility study confirmed that this appeared a need in the current circumstances. So the study as such is just an identification of topics for discussion. So the first thing that we should say is that the study is an inventory of areas that we should be considering to see how we can have better trade finance support for our operators. It's not even, I would say, a range of options from which we will take one. It is rather ideas that we are testing with the member states, with the export credit agencies, that we are discussing internally within the institutions to see what is worth taking forward. One recommendation and something that we are already taking forward is the better coordination between trade finance and development finance. So that's something that we are taking forward. So this whole of government approach that would start by facilitating transparency and better coordination between the financial instruments of the union and those of the member states to maximize our collective impact. And the way we've done this is not just through the feasibility study, but through a staff working document that we have published this year, together with the INPA and together with the EAS, where we map out the various tools that the union has, and we assess the extent to which they are coordinated. And the conclusion is they are not, but we also assess the extent to which they overlap to see the scope for better coordination. And the conclusion is that there are significant overlaps in notably low and middle income countries, also in the sectors where we deploy our financial tools. And this suggests that there is scope to better coordinate trade finance and development finance, and that the union would benefit from that coordination. Naturally, that coordination would contribute to Global Gateway. That's obvious because of the coincidence with the very objectives of Global Gateway, and that enhanced coordination is something that we are now intending to take forward through the creation of an expert group that hopefully will be set up already at the beginning of next year, and which will basically make sure that everyone, stakeholders, institutions from the member states, from the union level, that has a role to play in supporting the international business of our operators financially would be there, so that we can start with basic transparency and then move in the direction of supporting specific projects. So there would be like a horizontal formation of that expert group, and then we would also work project by project. So that's the idea, starting with information sharing, but then in the direction of being able to have financial packages that are attractive for our operators to benefit from when they compete internationally. So that is something that we are already taking forward, and where we are basically finalizing now the setup of this expert group. The feasibility study mentioned other possibilities, including the question of the facility, the EU facility. The next steps in that regard are connected to the role that we see for the Union to get involved, notably in strategic projects. And for us right now, the most urgent priority is Ukraine. And for that reason, when the Commission put forward its proposal for the midterm review of the current MFF, it included a Ukraine facility, and that Ukraine facility, which would basically bring together the various tools to support the funding of Ukraine, included a reference to export credit agencies. Of course, we still need to see what the legislative process produces at the end of the year on that particular proposal. But hopefully this opens the way for a union level involvement that would ultimately allow export credit agencies to rely on the union budget, perhaps through guarantees or counter guarantees, to support their operations in the particular case of Ukraine, where the risks and the amounts that will be required, notably for the reconstruction, will probably be excessive for export credit agencies, national export credit agencies, to fill the demand that will exist. So this comes on top of another initiative on Ukraine that you may have seen announced in the recent SME relief package, which is a pilot project that DG GROW is putting together with the EIF, and that will already support SMEs, European SMEs, through a counter guarantee tool that would basically support the Ukraine portfolios of European export credit agencies in favor of SMEs. So that's in a way a test case as to how the union budget can be mobilized to support the business of our export credit agencies. So that's the concrete work that is going forward in terms of designing or considering a union facility for export credit, which is basically the second priority strand that we are considering in this regard, in follow up to the feasibility study. And the final one is continuing work in the OECD, essentially to reduce support for fossil fuel projects. So it's the sustainability angle, if you want, of export credits. Continue on the footsteps of what we did with the ban of the support for coal-fired power plants. And that is something that we will be taking up already at the next meeting of the participants of the OECD in November and next year. So that is the picture on export credit. A lot has been happening lately, and the building blocks for a strategy are there, and we will continue constructing on that basis to have a better framework of support through the financial tools of the Union for our operators abroad. I would leave it there. And now for the dialogue, I see that I get a phone call. Yes.
If you keep your phone on just against your ear.
Yeah. So if you can hear me. Yeah.
Yeah. But if you keep your phone off speaker and just hold it, and then I'll give it to Richard, and he should be able to relay the question to you.
Okay. You can still hear me?
Yes.
Okay.
Just take your phone off speaker and put it against your ear.
So you want me to?
And just
Like this? Okay.
Be able to hear me now, right?
Yes, I can hear you. Okay.
Wonderful. So thank you, Antonio. That was extremely interesting. There were a number of takeaways, at least for me. And the most frightening one is the competitive position in time, and that we are losing vis-a-vis, you mentioned the US and China, and that something needs to be done about this. And I must say, from the side of the private market, we are more than willing to help. Now, would you have an idea how the private market could be willing to help in this respect? Because I heard you talk about ECAs, but the private market probably has a role as well.
Yes, of course. No, absolutely. Of course, the first thing is, can you hear me? Or
Yeah, I
should
can hear
speak
you.
like
I can hear you fine.
Yeah. Okay. So, I mean, ICISA's members are mainly active in the short-term segments. Some are reinsurers, and of course, I think you can start by sharing knowledge and experience, and there's definitely a reflection ongoing on how public support to export credit offering of the Union as part of the EU strategy can be improved. Of course, it is also for ICISA members to see how they can best market their products, how they can best be offered to the public, perhaps with the support also of authorities in charge of export promotion in the various member states. And then I can also mention the expert group that we are setting up, where we want to have everyone around the table, and where we can also organize, let's say, ad hoc presentations or individual presentations of individual actors, so that this angle is covered as well. So that's something that so your involvement somehow in the enhanced coordination, the better coordination of the tools that are available, I think would also make sense, and we will keep that in mind when we set up the expert group.
Thank you. There is an amount of unrest amongst our members saying the DG Trade is only working with ECAs. I would love to hear you say that the private market is welcome for a dialogue and should be taken along in those strategy discussions. Is that correct?
Yes, I mean, I think that the feasibility study, as you noticed, went very much into the question of short-term support. We understand that. I mean, you had an issue with that, or with the way things were presented in the study, and that you didn't see, let's say, support in the study for the conclusion that let's say private capacity and appetite for offering short-term cover is insufficient. But they definitely put a focus on that. The fact that the consultants put a focus on that doesn't mean that we intend to act on that. But the study did put the issue on the table. What we will probably do will be just making sure that any concerns that the study may have identified on the part of export credit agencies is dealt with DG Comp, because that is also something that the study covered through the appropriate dialogue. But our focus in terms of follow-up and will be, when we consider a EU facility, will be on medium and long term, of course. That's how we intend to take this forward. And then, but to the extent that short term is relevant, it can be incorporated in one of the meetings of the expert group, which, as I have explained, doesn't exist yet, but we are moving in that direction of establishing it.
Thank you so much. And when talking about the feasibility study, one of the points in that feasibility study is the support for the SME segment in particular, because that seems to be lacking in some cases. What, in your opinion, can be done to address this gap specifically towards SMEs? I hear you've noted specifically the ones in Ukraine, but I think it goes a little bit further than that.
Yeah, I think there's something to be done first to address the knowledge gap. I think there is a knowledge gap. Definitely, the problem of poor access to finance for SMEs was highlighted as a gap in the feasibility study. SMEs are not very aware of the options, at least when it comes to the support of export credit agencies. Probably trade finance banks are also not very active for SMEs, at least in some member states, perhaps because of that knowledge gap, because also of cost considerations. Which is natural because access to export finance is costly for small transactions. So this is something we're still analyzing, and felt that this was an issue where member states would be better placed to be active to support SMEs. And as I said, I've mentioned already trade promotion institutions. That's perhaps an angle that can help. There is also, I mean, the first mechanism in support of SMEs. Let's say EU level tool covering export credit agencies is specific to SMEs. So it's this SME relief package that I mentioned, and that includes a pilot facility where there would be 300 million euro to support SMEs business in Ukraine, essentially through transactions supported by national export credit agencies that would be insured up to a certain percentage by the EU budget through InvestEU. So that is something that we are doing to support SMEs in particular, and most likely through the implementation of that program, we will learn things about SMEs and how they can benefit more from export credit. So also work in progress, and something that requires all actors to try and unplug that knowledge gap as a first step.
And I hope we can help in this, because, for instance, in your home country, SME private credit insurance plays a very, very large role. Mm-hmm. And if we can transplant that into other markets, I'm sure that will help. Mm-hmm. Now, a question I have here from two different sides, and it says the following. There is sometimes a tension between the political and economic case to support exporters and the commercial reality of underwriting certain risks. To what extent can this be addressed through the different policy options available? And Shamala is giving the example of the aviation industry, where specific to that, the fuel in the aviation industry is considered a very high-risk industry, but still very, very necessary. Now, how can the policy options support where the private market would see the risk as a little bit too big, but the economy as a whole would benefit. What are your thoughts on that, please?
Yeah, I mean, there's definitely that tension, and we're trying to see how the tools can deal with that. And I think we already see that there is an evolution, if you want, in the mandate of export credit agencies and in the way export credit agencies apply their mandate. This is shifting. I think it is increasingly recognized, and we see that happening, that export credit and export credit agencies should also contribute to, if you want, geopolitical objectives, if that is what we mean with the political and economic case for supporting certain projects. Of course, we would still have to make sure, and they will still have to make sure, that everything that they do is in line with the OECD arrangement, of course. And this has to also be made consistent with the fact that the basic approach is that they work on demand. But obviously there is a case to more efficiently mobilize existing tools, notably to achieve strategic objectives. And this is one of the messages that has come from the discussions that we are having with member states and export credit agencies in the Council following the feasibility study, that certain strategic objectives may justify the involvement of the EU level, and Ukraine is the best possible example, so one we should be now working on. Of course, a more proactive role of governments would also be relevant and important, but I think there's a clear trend there to consider, so not just for the EU level, but more generally, let's say, this strategic element, and a more proactive attitude on the side of export credit when going about their business. Of course, enhanced coordination. So the tool of enhanced coordination that we want to push now would also be a response to this, because we are going to be trying to coordinate better, not to tie, of course, trade finance with development finance, but to coordinate better, and that would naturally increase. I mean, if we are able to actually get that combination right and to combine both better, that would increase, I think, the appetite of export credit agencies for certain transactions with a strategic benefit, and on that basis, it would increase as well the appetite of the private sector for transactions with a strategic benefit. Meaning, I mean, I mentioned Ukraine, but we can mention other. We can mention also sectoral priorities. For example, I don't know, digital or transport or climate objectives. And of course, if we are able to then have an EU layer, perhaps a guarantee at the union level for certain strategic objectives, that would, of course, further contribute to help export credit agencies to intervene in more challenging transactions involving higher risks. But I think enhanced coordination and potentially a union facility can help square that circle that was at the origin of your questions, the tension between political and economic case and then the commercial reality.
Thank you so much. That's a meaningful and very clear answer, and we were hoping for that. Now, not so much a question, but a suggestion from one of our active members. Mario is saying European private insurers may boost ECA's activities by further insuring commercial loans for the 15% down payment required by the consensus. I don't expect you to react straight away to that, but that is something that you might consider to boost capacity further.
Mm-hmm. Okay. We'll add that to the ideas that we're collecting.
I'm looking at my screen. There are no further questions at this moment. So, ladies and gentlemen, this is your chance to put a question to Antonio. 3 seconds, maybe. Yep, that'll be 3. And that means we have come to the end of this first item of the Trade Credit Insurance Week organized by ICISA. Antonio, thank you very much. We were delighted to have you with us, and we were delighted to have you give some clear statements which our members and the entire community can work with. I thank the audience for coming, for your thought-provoking questions, and any other questions to the speaker or to ICISA for that matter. You can always ask on our website, icisa.org, or via secretariat@icisa.org per email. Now, a reminder, this webinar, just like every other one of this week, can be seen after this week on our website, on our resources section. And that was the first item of our TCI week. The next item will be at 3 p.m. CET, 2 p.m. UK time, and importantly also 9 a.m. Eastern Daylight Savings Time. And that will be another strategic topic, the path to growth. How do we grow our industry? How do we grow our industry, and how do we unleash the potential of the trade credit insurance distribution? We hope to see you there, and we hope to see you for the other items this week. And for now, this is ICISA signing off from Schiphol Airport in the Netherlands. Have a good day, have a happy Monday, and we hope to see you again this week. Thank you so much.